Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. Joining me today, my good friend and special guest, Jeremy Reddick with Virtue Capital over in Brentwood, Tennessee. They are the advisor to advisors. As I talked about outside of the last break, one of the things that they do is they provide us a lot of help with regard to different strategies that they develop. And they're always researching, just as I am, always looking to find a better mousetrap, right? Find a better way to do this. Find a better way where I can get maybe a little more return, reduce risk, manage that volatility even better. So there's a lot involved. And some of the things we talk about too, Roth conversion, some of the strategies that we use in helping someone attain those goals. Just like when we're talking about taking income in retirement. This is one of those areas that gets a little tricky, just like investing in retirement. We have to be tax efficient. Sometimes the thinking, I just talked to a client on the phone yesterday, and one of the things that we were getting into was how to take care of income over the next couple of years. As you're leading into getting to required minimum distribution and what that might look like. So in the situation, basically, we're looking at, we've got, in his situation, he's got non-qualified funds, right? Money he's already paid tax on. Money that are in his retirement accounts, tax-deferred money, and he's also got some Roth IRAs, so money that is growing tax-free and will be tax-free when we take it out. But when we're looking at that, his tendency, and most are, the tendency is I'm going to use up my taxable dollars first because I want to defer, right, my income as much as I can and take advantage of not paying taxes and using that money to earn money. And that's a good plan. Tax-free, same thing. The thinking being that that's the last money I touch because I want to have those tax-free benefits when everything else is gone. That's when it's going to be most important to me. However, a given situation, right, in his, by blending together what we take out now, right, we're going to minimize his taxes. We can keep him, for instance, in a 12% bracket, even though his income level would put him up around 22, 24%. So we do that by where we take the money. And that's where sometimes invading that Roth, in particular up until RMD age, might still make sense in the overall strategy, which is to minimize taxes over my lifetime. So sometimes a client's going to have such a large RMD that we try to address that with Roth conversions, but there are sometimes it just isn't going to work out. We're going to end up paying more in tax to do the conversion that we're going to pay when we take it out. So it doesn't make sense then. But we can still minimize taxes. So until RMD age, I've got one client, for instance, we zeroed out her taxes completely while still providing her income that would have had her up in the 12 to 22% bracket by how we took the income. And then when she hits RMD age, we know at that point, those RMDs are going to dictate to a certain degree the taxes that she's going to pay, and we're going to be more limited when that occurs. So at least, over that, in her situation, I think it was about 8 years, we were able to zero out her taxes for 8 years, and then, she's going to have some tax with RMD. Each situation is different. The gentleman I mentioned, the same kind of thing, where to take that income from these different pools, gets him the income he needs, but keeps him in a lower bracket, even though the income otherwise, if he was taking it all from the IRA, he'd have been up in a 22, 24% bracket.
And Hank, let me just say, most advisors, many advisors, I shouldn't say most, many advisors strictly just look at your investments. They don't have a relationship with an elder law attorney or a CPA like Hank does, our firm does. They don't look at the holistic approach. It's just, here's your investments, here's what I recommend you change, and that's it, and then you're kind of on your own. They're not looking at it. Some of them aren't looking at it from a tax perspective, right? Some of them aren't experts in income planning, if you will, or have a lot of experience in income planning. Maybe don't have certain tools that could help subsidize income. So I just think it's really important to work with somebody that looks at all of those things. We've worked with a lot of advisors over the years, and I can say with certainty, not all advisors are as comprehensive is what Hank is and what our firm is.
This is one of the things, we get into everything, just like I talked about in 7 Steps to Financial Freedom in Retirement, is in that planning, you're looking to, in fact, cover a lot of things. You get into taxes, you get into how am I going to stay ahead of inflation? That's where the investing piece comes in. When I'm taking income in retirement, how to do that in the most tax efficient way, and all while managing the risk. right? And at the same time, getting enough return to stay ahead of inflation and taxes to protect the purchasing power. A lot of them, and you're dealing with Social Security, you've got Medicare. There's a lot of things that also are important in terms of your decisions when to take Social Security as an example to maximize that benefit to you. Medicare, which plans to take, how to manage health care costs in retirement, which are likely to be out of pocket over $300,000 for a 65-year-old couple. So this is one of those areas, over your lifetime. So this is one of those areas we need to manage as well. That if we can minimize those costs, if we can minimize your taxes, if we can maximize that return while managing the risk, there's a lot of things to balance, but we do it every day with all my clients, and this is what's going to help you be successful as well. I hope these tips are helping you. And Jeremy, I want to jump back make sure we don't run out of time here.
Sure.
On this stop loss and market buyback features. This is how that stop loss, a little kind of chart in terms of how it might work.
Yeah, it's a hypothetical example, just trying to illustrate here, but I'll walk you through it. As I had touched on earlier, the reason why we chose a 12% decline is, historically speaking, again, when the S&P closes down 12% or greater, very high probability the market continues downward. So that's why we chose 12%. I will tell you, it's not on your account. If the S&P 500 closes down, that means we go equity risk off, regardless of which strategy, the stop loss that you're in. We sell the equities the next day, and we go to corporate bonds, and we're invested in there until the buyback trigger happens. And by the way, the buyback trigger, the reason we chose the two triggers we did is based on the history of the stock market. And the first trigger, we won't touch on the second, but the first trigger, I'll just give you an example here. You can see at 12%, hypothetically, we got out of the market and we went out of equities and we went into fixed income. And in this example, we show that the market hit a bottom at 30%, went all the way down 30%, hit a bottom, started climbing back up. We would have bought back in at 15 in this example. And if it goes down further than 30%, then the buyback is much quicker than that, because again, historically speaking, if the S&P declines 30% or greater, when it hits a bottom, it comes back much faster. Last year, Hank, was a prime example, 34% decline in 22 trading days. We were out of the market and back in the market in about 30 days or so because of that.
How fast it happened.
Yeah.
This is one of the areas, too, when you're looking at investing. Now, when we're talking about these triggers, there's other factors that are going on. There's some trailing returns that are looked at, so it's not, we're just giving you kind of the simplified version of it,
for sure,
just so you can understand the concept. There's a lot more to it. This, and it's, adding this kind of insurance, if you will, is the way I look at it, to my portfolio. And sometimes, there are other issues that get involved here. Tax implications, for instance, on non-qualified funds. So sometimes I've got clients, for instance, where we have IRAs and Roth IRAs that are utilizing the stop loss overlay, right, to help reduce the risk. But we got non-qualified. I've got one, for instance, we looked at recently. They got over almost $1 million in gains. All right. Well, when you got $1 million in gains, you don't want to trigger a capital gain on $1 million, right? So that one we keep that out of the stop loss overlay. But by doing it the way we have, we've still protected more than half of the money that's invested. So we still, again, reduce volatility. We started with asset allocation. We reduced and managed our risk. We add in a stop loss overlay on half of, let's say, the funds. Now we've reduced it even further. So if we can't do all, half a loaf in this situation is better than none, and it's still going to give us the desired result of reducing and managing that risk.
And incorporating tax planning, right? Hank,
yep.
That's why you did that. Going back to your comments on why you invested where is because of tax planning.
Exactly. And this is where it's so important, too. When you're talking to and this is why I like the holistic approach, as Jeremy alluded to, where we're working with the accountant, we're working with the estate planning attorney. We want to make sure everybody's on the same page, and we're developing a strategy. Think about that. You've got, three heads that basically helping as well in coming up with the different ideas for the different things, each with their own specialty, each helping coordinate
in concert,
right, and getting
which is
exactly the team approach. So you're going to have the best result from that. This next slide, in fact, this will illustrate those without that type of planning, if you will. The individual investor, and I know this chart may be hard for you to make out here, but I'm going to let you know on the fourth one in, that little orange block that you see on your screen, the average investor...
Over 20 years.
Yep, over the past 20... 2.5% return. And when you compare that to the S&P, to the market at 6.1, this is one of those reasons, right? I mean, you're looking at a huge difference, almost, what is it, about 35, 40% of what the market return. In other words, that average investor, if they just put their money in the S&P 500 index fund, would have done way better, almost 3 times better, than the strategies they're employing. And this is, a lot of this has to do with getting market timing, right, where they get scared and
Based
they jump out of the market. Emotion, exactly. And they get greedy at certain points, maybe inappropriate times. And so they're in and out of the market at the wrong times, trying to, you know, just more, as Jeremy just said, more based on emotion, not based on a strategy that's been proven to work. Another is stock picking. This is another area, or chasing the latest, hottest stock tip, you know, or looking at a mutual fund that's did great last year, and so you move everything over to that. And you just keep jumping around, and this creates a problem for you in that you're increasing risk, and as you can see, you're reducing return at the same time. Are we taking another break?
Already?
Already. And then when we come back, I'm going to talk about these bull and bear markets. We've got another graph I want to share with you, and this is another one of the expectations of how the market works over time. First, a break. Join us here. We'll be right back on the Retirement Report.